Hi everyone, today we'll be going over accounts, May June 2021, paper 3-2, question number 1. This is structured paper 3, which consists 6 questions, each of 25 marks, and we are also given a time limit of 3 hours. So we will be attempting to solve each question under 30 minutes. And question number 1 is part of section A, which deals with financial accounting. So without any further delay, let's get started. Alan and Brian were in a partnership, sharing profits and losses in the ratio of 3:2, and the statement of financial position of the partnership at 31st December 2020 was as follows. Alright, and Z Limited acquired this partnership business on 1st January 2021. Most of the assets and liabilities of the partnership business were taken over by Z Limited, and we are also given the terms of the acquisition. So let's have a look at our first question. Now we need to prepare the realization account. And whenever we are talking about realization account, we need to record the assets at its previous value on the debit side, and then we need to record its settlement value on the credit side. And similarly, we will be recording all of the liabilities original or previous value on the credit side and its settlement value on the debit side, and then we'll move towards figuring out whether there is a profit on realization or a loss on realization. Alright, so let us start with the previous valuation of our assets. We can see that previously property was valued at 300,000. So we are going to record this on the debit side of our realization account. Let's do that. So that will be property with the value of 300,000. Okay. Then next we have equipment with the value of 71,000 and motor vehicles with the value of 62,000. Let's record these two as well. And these will go on the debit side since this is the original value, right? So we had the equipment with the value 71,000 and motor vehicles with the value of 62,000. Now let's move towards additional information in order to see how these three assets were settled. If it were taken over by the existing partners Alan and Brian, or it was acquired by Z Limited. Let's have a look. Okay, right here we can see that property and equipment were revalued at 350,000 and 68,000 respectively. Okay, so if any of the assets are being revalued, it means that those assets will be taken over by Z Limited. So what we can conclude is that property and equipment will be taken over by Z Limited, and this takeover value will be included in the purchase consideration value, right? Okay, then we are also told regarding motor vehicles. One motor vehicle was valued at 29,000 and another motor vehicle would be taken over by Alan at the value of 28,000. Okay, so the motor vehicle valued at 29,000 will be taken over or acquired by Z Limited, and its value will be recorded in the purchase consideration value, right? But this another value would be taken over by Alan, and it means that its value will not be recorded in the purchase consideration. So we need to record this value of 28,000 on the credit side because this is how we are settling one motor vehicle, right? And this will go under the capital account of Alan. Let's record this. So towards the capital account of Alan, because since he is the one taking over the motor vehicle, right? And he will take it over on the value of 28,000. And for the values of property and equipment, I already said before, it will be included in our purchase consideration. So let's have a look at our purchase consideration so that we can record its value on the credit side. Then we are told that inventory would be taken over at the value of 20,000. So this also means that inventory will be taken over or acquired by Z Limited. So we need to record its original value on the debit side. Let's have a look at the statement of financial position for its original value. We can see inventory right here at the value of 24,000. Let's record this in our realization account. So that's inventory with the value of 24,000. And since this is being acquired by Z Limited, its new settlement value will be included in the purchase consideration itself. Then we are also told that trade receivables of 4,400 were considered irrecoverable, and the remaining trade receivables would pay 30,500 to the partnership in full settlement of their accounts. Okay, here we can ignore the irrecoverable debt of 4,400 and we can say that all of the remaining trade receivables will be settled at the value of 30,500, right? So this is the new settlement value, which should be recorded on the credit side since trade receivables is an asset, and the original value of trade receivables should be recorded on the debit side. So let's have a look at our original value given right here. So trade receivables amounted to 36,000, which is the original value to be recorded on the debit side, and its settlement value is 30,500, so this will be recorded on the credit side. Let's do that. Okay, so trade receivables with its original value of 36,000, and then again trade receivables with its settlement value of 30,500. Okay, again, let's have a look at our additional information. Then Z Limited would not take over the bank balance of the partnership. So since they are not taking it over, we do not have to record its original value and the settlement value, right? So we can completely ignore the fifth point. Then the partnership would pay 14,400 in full settlement of the trade payables of 15,000, and the remaining trade payables would be taken over by Z Limited at their book value. Okay, let's have a look above. So we can see that the total trade payables amounted to 33,000, and out of 33,000, for 15,000 trade payables, the partnership will actually be paying 14,400, right? And then for the remaining value, which will be 33,000 minus 15,000, which is 18,000, right? So this trade payables of 18,000 is going to be taken over by Z Limited. So let's record the original value of 33,000. And since trade payables is a liability, its original value would be recorded on the credit side, and the settlement made by partnership itself will be recorded on the debit side, whereas the settlement made by Z Limited would again be included in the purchase consideration, right? So we can just not record this right now, but we need to record its original value of 33,000 as well as the settlement made by the partnership. Let's write it down. Trade payables is a liability, so the original value will go towards the credit side. Which amounted to 33,000. And the amount settled by the partnership will go towards debit side, which amounted to 14,400. And the remaining balance was taken over by Z Limited, will be recorded in the purchase consideration value. Let's move towards another information. Then we're told that the purchase consideration for the partnership business was 500,000, and this is the amount to be recorded on the credit side in the realization account. Let's record this. And since the purchase consideration is being paid by Z Limited, we can record it under their name. And this amounted to 500,000. Since we have included everything given in all of our additional information, we can move towards figuring out whether there was a profit on realization or loss on realization. And in order to figure that out, we need to figure out the balance for the heavier side. So let's first figure out the total for debit side, right? That is going to be the sum of these six amounts. So that's 300,000 plus 71,000 plus 62,000 plus 24,000 plus 36,000 plus 14,400, which results in the value of 507,400. Now we will repeat the same process for credit side. That's going to be the sum of these four values, 28,000 plus 30,500 plus 33,000 plus 500,000, which gives a total of 591,500. We can clearly see that credit side is the heavier side, which means that our balancing figure will be on the debit side. And whenever the balancing figure is on the debit side, it will resemble the profit on realization. So let's write it down. We have profit on realization. And this profit should be divided among the partners of the partnership business, who are Alan and Brian. Okay, now in order to figure out the profit on realization, we first require the total value, which is obviously going to be the total of the heavier side. So that's 591,500. Let's write it down. Now, as I said before, profit on realization will act as the balancing figure, right? And whenever we're trying to figure out the balancing figure, we just need to subtract these amounts from the total. And we already figured out the total for these amounts, which is 507,400. So we just need to subtract this value from our total, which is going to be 591,500 minus 507,400, which gives our profit on realization to have the value of 84,100. Now we need to divide this profit to Alan and Brian on their profit sharing ratio, which was given above. So let's have a look. We were told that profit and loss sharing ratio was 3:1. So out of 5 parts, 3 parts belongs to Alan and 2 parts belongs to Brian. We will use this and figure out each partner's share of profit. For Alan, the total profit on realization is 84,100, right? And 3 parts out of 5 parts belongs to him. So that's times 3 by 5, which gives the share of profit on realization for Alan to be 50,460. Now for Brian, we have the total of 84,100, and we know 2 parts out of 5 parts belongs to him. So that's times 2 by 5, and this gives the share of profit on realization for Brian to have the value of 33,640. Okay, this concludes the first part of this question. Now we can move towards the second one. We now need to state 2 differences between a realization account and a revaluation account. Okay, so the very first thing to remember is that realization account is prepared when the ownership of assets is changed. Similarly, in this case, we can see that we prepared a realization account when the partnership was being acquired by Z Limited, which means that previously the assets owned by Alan and Brian now goes towards Z Limited. So the ownership has definitely changed, right? But in case of revaluation, it is prepared when the ownership of assets has not changed. So that is the very first difference. Let's write it down. Realization account is prepared when ownership of assets has changed, whereas revaluation account is prepared when ownership of assets have not changed. And in case of realization account, we record the net book value and the consideration amount, right? But in case of revaluation, we record the increase or decrease in the assets value. Let's write it down. In realization account, net book value and consideration amount are recorded, but in revaluation account, increase or decrease in assets value are recorded. Alright, this concludes the second part of this question. Now we can move towards the third one. We now need to prepare a statement showing the final settlement to or from each of the partners. Okay, so whenever we are trying to figure out the settlement amount, we obviously need to start with our capital account and then adjust the current account, right? So let's have a look at our statement of financial position to see the capital account balance for our partners. And we have our capital accounts right here. For Alan, it amounted to 250,000, and for Brian, it amounted to 200,000. Let's record this value. So this is the value for capital account. And we have the value of 250,000 for Alan and 200,000 for Brian. Now we need to adjust the current account balances. Let's have a look above. We are given current account right here, And for Alan, it amounted to 27,000, which is a positive amount, which means that his capital account balances will be increased by 27,000. But in case of Brian, he has the amount of 8,000, but in a bracket, which resembles a negative value, right? And it means that Brian needs to pay back 8,000 to the partnership. So this amount will definitely decrease his capital account balance, right? So we need to add 27,000 for Alan and subtract 8,000 for Brian. Let's do that. So that's positive 27,000 for Alan and negative 8,000 for Brian. Okay, and we already figured out that there was a profit on realization, right? And this profit should also be added towards their capital account. Let's do that. Let's have a look at our realization account. So for Alan, we figured out the profit to be 50,460, and for Brian, it was 33,640. Let's record these two amounts in our statement. That's 50,460 and 33,640. Okay, and the next thing was that Alan took over one of the motor vehicles, right? And if he is to take the motor vehicle, then he obviously needs to pay the amount to the partnership, which will definitely decrease his capital account balances, right? So you need to record it. That's going to be motor vehicle taken over. Let's have a look above. We recorded it in our realization account as well. Right here towards the capital account of Alan, he took over the motor vehicle at the value of 28,000, which means that he needs to pay back 28,000 to the partnership. Let's write it down. That's going to be 28,000, but since it will reduce his capital account balances, it's a negative amount, so that's a bracket. Okay, let's have a look at additional information. We might be given something regarding the settlement to the partners. Okay, in the seventh information, cash of 23,000 is payable into the partnership's bank account, and ordinary shares of $1 each at a premium of 0.25. Ordinary shares would be distributed to the partners in the proportion of their capital account balances at 31st December 2020. So the very first thing to remember here is that our purchase consideration is 500,000. So this is the value that the partners will be getting for selling their partnerships to Z Limited. And out of 500,000, we are told that cash amount of 23,000 will be payable into the partnership's bank account, right? So if 23,000 goes there, then the remaining value is going to be 500,000 minus 23,000, which amounts to 477,000. And this value is to be distributed as the ordinary shares of nominal value 1 and the premium of 0.25, right? And this ordinary share would be distributed in the partners proportion to their capital account balances. So let's have a look at the capital account balances. So the total is 450,000, and out of 450,000, 250,000 belongs to Alan and 200,000 belongs to Brian. So on this particular basis, we need to divide the amount of 477,000 in the form of share capital towards two partners. Let's figure it out. For Alan, he's going to get 477,000 times, and we know that out of total capital of 450,000, 250,000 belongs to Alan. And this is our basis of apportionment. So that is just going to be 250,000 out of 450,000, which gives the amount of shares for Alan to be 265,000. Now we repeat the same process for Brian. That's the total of 477,000. And out of 450,000 capital account balance, 200,000 belongs to Brian. So that's just going to be 200,000 divided by 450,000. And this gives the share for Brian to have the amount of 212,000. We need to record these two values into our statement as well under the heading of ordinary shares. Let's do that. So that's ordinary shares. And for Alan, we figure out the value to be 265,000. And for Brian, that's going to be the value of 212,000. And remember that they are getting the ordinary shares in return for selling the partnership business, which means that since they get this value is definitely going to decrease their capital account balance or the amount to be received from the settlement of acquiring by Z Limited, right? So this definitely decreases their capital account balance, so that should be in a bracket. Now, since we've concluded everything, so the difference now is just going to be the amount payable to the partners or payable by the partners. So let's figure it out for Alan. That's going to be the sum of these five amounts: 250,000 plus 27,000 plus 50,460 minus 28,000 minus 265,000, which results in the positive value of 34,460. Since this is a positive amount, this still reflects the amount that Alan is yet to receive from the final settlement. So this is definitely payable to the partners from the bank account. So I'm just going to write it down: payable from bank account. Now we repeat the same process for Brian. So that's going to be the sum of these four amounts: 200,000 minus 8,000 plus 33,640 minus 212,000, which again results in the positive amount of 13,640. And since this is a positive amount, this is obviously the amount still payable to Brian from the bank account, right? And this concludes our statement as well as the third part of this question. Now we can move towards the fourth one. We now need to calculate the goodwill arising from acquiring the partnership business by Z Limited. Okay, so the thing to remember is that goodwill is just the difference between the purchase consideration minus the net assets value taken over at takeover. Okay, we know that the purchase consideration paid by Z Limited to the partnership is 500,000. Now we just need to subtract our net assets, and net assets is just going to be the difference between assets and liabilities. So I'm just going to write down all of the assets at a positive value, and we need to subtract the liabilities. Let's have a look above. So for the very first information, we were told that property and equipment were valued at 350,000 and 68,000. So this is the amount at takeover, right? So we need to record these two amounts, and since property and equipment are assets, we will be writing these as positive. So that's 350,000 and 68,000. Let's write it down. 350,000 plus 68,000. All right, then we have one motor vehicle taken over by Z Limited, which amounted to 29,000. Again, this is an asset, so that's a positive. Let's write it down. So that's plus 29,000. Then we have the inventory taken over at the value of 20,000. So since inventory is an asset, we will be adding this amount as well. That's plus 20,000. And they took over the trade payables as well. So for trade receivables, everything was settled by the partnership. So this will not be recorded in our purchase consideration, right? Then right here for trade payables, the remaining trade payables will be taken over by Z Limited. And we figured out the value for remaining trade payables to be 18,000, right? We need to subtract it. Let's do that. So that's going to be minus 18,000. Okay, now let's first of all figure out the net assets value. So that's 500,000 of purchase consideration, and everything in the bracket will be the net assets. So that's going to be 350,000 plus 68,000 plus 29,000 plus 20,000 minus 18,000, which results in the value of 449,000. Now we can easily figure out the goodwill value. That is 500,000 minus 449,000, which results in the goodwill to have the value of 51,000. And this concludes the fourth part of this question. Now we can move towards the fifth one. We are given additional information. Before acquiring the partnership business, Z Limited had two equal shareholders and a total share capital of 1 million. These shareholders are the directors of the company. A few months after acquiring the partnership business, Z Limited decided to acquire the business of a sole trader. and the agreed consideration would be 800,000, but the sole trader has requested the following. The consideration would be settled by 640,000 ordinary shares of Z Limited and a directorship in Z Limited. Now for the fifth part, we need to advise the directors whether or not they should accept the request of the sole trader. We need to justify our answer showing relevant calculations. So for calculations, we will be calculating the total share capital. So let's figure out the share capital before acquisition of sole trader. So that's share capital. So before the acquisition of sole trader, we already acquired the partnership business, so we should also include the ordinary shares provided to the partners of those partnership business, right? And before the partnership business, there were 2 equal shareholders with a total share capital of 1 million. So that's 1 million. And now we need to add the shares provided to the partners Alan and Brian. Let's have a look above. We already calculated it right here, the ordinary shares. And this amounted to 265,000 for Alan and 212,000 for Brian. But the most important thing to remember here is that we are only calculating the total share capital, which will not include the premium value, right? And ordinary shares are provided to Alan and Brian at a premium, which is given above. Right here, we can see that ordinary share is of $1 each, but it is given at the premium of 0.25. All right, so the value at which we are providing the ordinary share for Alan and Brian is 1.25, right? But we only include the value 1 in our share capital. First of all, let's figure out the total ordinary shares for Alan and Brian. That's 265,000 for Alan plus 212,000 for Brian, right? Which gives the total value for both Alan and Brian to be 477,000. Okay, and we only require one part out of 1.25 parts of this value, right? So for share capital, that's going to be the total of 477,000. And only 1 out of 1.25 is the share capital. So that's times 1 by 1.25. And this gives the share capital provided to Alan and Brian to have the value of 381,600. So this is the value that we need to add in order to figure out the total share capital before acquisition of sole trader. Let's write it down. So that's 381,600, which gives the total share capital to be 1,381,600. And now after the acquisition of sole trader, that will be the previous value of 1,381,600, and we are also providing 640,000 ordinary shares, and since the nominal rate is 1, the share capital will have the value of 640,000, which gives the total share capital value after acquisition of sole trader to be 2,021,600. So let's figure out the shareholding for the 2 directors, right? So that's going to be shareholding. Okay, before the acquisition of sole trader, 1 million out of 1,381,600 belong to the directors. So we're just going to figure that out in percentage. That's 1 million divided by the total of 1,381,600 times 100%, which gives the shareholdings of directors before acquiring sole trader to have the value of 72.38%. Now we repeat the same process for after acquisition. Again, after the acquisition, 1 million out of total of 2,021,600 belongs to the initial shareholders who act as the directors. So that's 1 million divided by 2,021,600 times 100%. And this gives the shareholdings of the previous directors to have the value of 49.47%. Okay, now we can move towards non-numerical factors, right? So if Z Limited issues shares towards the sole trader for its acquisition, then it obviously does not have to pay any cash, right? So that maintains the liquidity position. That's a good thing. Let's write it down. By issuing shares, Z Limited is saved from paying cash. Okay, and similarly, the sale trader will also act as the director, right? Because that is the condition he presented towards the acquisition. And if that's the case, then the sole trader can also bring in his experience and expertise, which might enhance the performance of Z Limited. Let's write it down. The sole trader can bring in his experience and expertise. But if that's the case, then they will also appoint the sole trader as the new director, which means that the original shareholders will lose the controlling interest. Let's write it down. The original shareholders will lose the controlling interest. And since there is the admission of new director, their opinion might clash with the original shareholders, which might result in a conflict. That's a risk. Let's write it down. There may be conflict with the new director. Now, based on these factors, we need to advise the directors whether or not they should accept the request of the sole trader. So if we accept the request, then obviously Z Limited does not have to pay any cash for the acquisition of the sole trader, and the sole trader can also bring their expertise, which will enhance the performance of Z Limited. That's a good thing, right? So in my opinion, the directors should accept the request of the sole trader. Let's write down the decision clearly. The directors should accept the request of the sole trader. Okay, this concludes the fifth part of this question as well as the entire question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.